Hello, I'm Alex Davies, founder of Wealth Club. Today I'm with Ian McLennan of Triple Point to talk about the Triple Point Ventures Fund. Hi Ian. First off, tell me a bit about Triple Point and your own experience.
Hi Alex. Triple Point these days manages 1.6 billion of assets. We do that for all sorts of different clients now. So we've got the UK government, we manage money for institutions, and of course for private investors who are the ones who will be interested in the VCT. But of course we started 2004 to run a VCT, and we've been running them ever since, and this is our 21st offer. In terms of myself, I'm a partner at Triple Point. I run our venture team. I've been there 12 years, always involved in the VCT EIS side of the business. But I wouldn't just focus on myself. We've also got a great venture team there. There's five of us. I've got a guy who works with me who's got great operational experience with startups, which is very useful in working out whether founders know their mustard. I've got a guy who's an ex-Magic Circle lawyer who helps us make sure we're getting the right protection for the investors. And finally, we've also got specifically an advisory committee for this VCT, which is 3 ex-business founders and current business founders who are very excited about entrepreneurial investment and help us from time to time with investment selection and mentoring the companies.
Okay, so tell me about the VCT. What's it aim to do for investors? How much is in it? Types of companies you look for?
Yeah, so I guess headline, we want to generate capital growth and some healthy income. We paid our first 3p dividend this summer, aiming for another 3p dividend next year, growing that over time to 5p depending on performance, but of course crucially also looking for growth in that £1 that you invest as well. We aim to do that by investing, I think, slightly differently from some of the other VCTs. So 3 things there. First, we typically invest a bit earlier stage, so we're often investing at the so-called seed stage, to use the jargon, and we do that because we think we can get better valuations. Second, we focus only on B2B technology companies, and we do that because we think it's good to concentrate our expertise, but also because our research suggests that the exits in the UK from startups are better for B2B than they are for the consumer-related businesses. And thirdly, which you'll have heard me talking about before, when we're picking the companies, we focus on a challenge-led strategy, which I can talk about more, but the aim is to focus more on the product is meeting a specific real-world challenge rather than just looking at a fancy product, and that way we can mitigate some of the risks.
Do you want to give me some examples of recent investments you've made?
Yes, so earlier this year we invested in a company called Quit Genius, which helps people to stop smoking. That's great in its own, but why have we invested in it? Why is it B2B? Why is it business to business? It's because smoking still costs health systems and health insurers a great deal of money. So it's a huge market. So Quit Genius's first customers are actually US corporates. So these are companies that are, of course, paying the health premiums for their employees or directly paying for their employees' healthcare. And if they can get them to use Quit Genius's app, which of course people can use on their smartphone, on their tablet, and gives them a self-help program, as well as, if necessary, direct access to a real-world therapist. If they can get people using that app, then it will reduce health premiums by up to 1/3. So there's a big opportunity there for businesses to save money by encouraging employees to do that. The NHS is also a customer. Much discussed, smoking still costs the UK over £1 billion a year in terms of healthcare. So it's an attractive large market. It's technology delivered, so it hasn't been disrupted by COVID. Even the conversations with therapists can happen over the app.
And any other examples?
Yes, one that I would highlight is Vine Technologies, which is an e-payments business, which is doing very well. So e-payments obviously is a huge market, $2 trillion a year and growing rapidly. So very much at the bigger end of markets, but something that we want to focus on. A big challenge for e-commerce companies is that the current payment systems, A, cost them a lot of money because they have to pay to the traditional networks, the card issuers, etc. And B, it also often takes them a while to actually receive the cash. So they spend a lot of money and time on that. Vine Technologies uses the new open banking rules to allow direct payments from a customer bank account to the e-commerce company's bank account. The open banking rules, rule changes are really, they're creating a lot of innovation in fintech at the moment. There's another company we can talk about as well, which is benefiting from open banking. And basically, Vine Technologies is cutting out the middleman for these e-commerce companies. So they're attracting quite a few customers. It's also got a great founder, CEO in Carl McGregor. It's a good example of a founder who has previous experience in the sector and also has previous entrepreneurial experience. So that's one we like.
And how is the portfolio faring? How's coronavirus treated your company?
Right. Well, it's been an interesting year. There have been some challenges which we'll touch on, but I would say that there have been some factors that have been favourable for us, being a younger VCT. So literally, because we came into COVID in March with still 55% of the portfolio in cash, that not only helps kind of the asset value, as it were, but it's meant that we can continue investing after COVID struck. We didn't have to kind of pause, as some did, and kind of worry about whether actually one needed to conserve capital in order to support existing portfolio companies. We were able to keep investing in new companies, and there were some good opportunities, particularly in Q2, Q3. So we've done 5 more investments post-COVID. And the second advantage is, of course, the portfolio that we did have coming into COVID, they were all pretty new investments in relatively young companies. So they all had decent cash runways coming into the economic stop, as it were. But also they're very nimble companies and can reacted very quickly to COVID, whether it's cutting costs or deciding to carry on investing. A good example would be Credit Kudos, another portfolio company, which again is using the open banking system, but this time to do credit ratings, to improve the credit rating system, make a much faster and more fuller credit rating available to people. And they very quickly created a new product post-COVID called COVID Credit, which was to help the self-employed use that banking information that they could get from open banking to apply for some of those government assistances that were around earlier in the year.
And challenges you faced?
And so also related to COVID, I should say that obviously in March, even though, despite what I've just said, we did look at the portfolio and kind of go, well, look, some of these companies are going to see a bit of a slowdown in sales in Q2. I mean, it was unfortunate perhaps having to look at valuations in March, as a lot of VCTs did, because there wasn't then a huge amount of information about how COVID was going to affect the economy and the companies. But we needed to do it because we were allotting new shares at the end of March. So even though we didn't have and don't have any exposure to direct consumer companies, remember we've got that B2B technology focus, we don't have hospitality businesses, we don't have leisure businesses, we did think it was right to make a precautionary reduction in some of the valuations for perhaps a sales dip in Q2. So we did make a provision that reduced the NAV by 6% at that time. I'm glad to say that since then, over the summer, recovery in sales across the portfolio looks pretty encouraging.
Good. And you're very sort of young VCT still. Have you had any exits?
Well, actually, we have. Maybe a little earlier than we expected, maybe or even ideally wanted, but we're not complaining. So in December, we sold a business called Adepto. Adepto is a human resources software company. We'd only been invested in it for 8 or 9 months. So in some ways, it might have been nicer to have a longer period for the entrepreneur to grow the business. But he did a pretty good job anyway. And a Californian company called Degreed bought that. It's a bigger company, of course, it's a much bigger company in human resources technology as well. We have chosen to take stock in Degreed as consideration rather than cash. We did have that option, but Degreed itself is growing pretty strongly. HR tech seems to be an area where there's a lot of exciting innovation going on, and it's a great opportunity to have a California tech company in your British VCT.
And how risky is it? So, is there a number of how many companies would you expect to fail? Is there any sort of calculations for that?
I knew you were going to ask that. I mean, obviously, early stage investing is risky. There are going to be failures. We do what we can to mitigate that, is the first thing to say. We do all sorts of things, but just to focus on a couple of them. I mean, the challenge-led investment thing we haven't really talked about a lot. So when we're picking the companies, as well as focusing on that B2B technology, we want to make sure that the product is really solving a real-world corporate problem or corporate challenge. So we start by asking the corporate customers how big of a problem this is, rather than starting by just analysing what the new product is at the potential investee company. And we do that because a lot of research, well, all of the independent research is showing that the biggest single reason for the failure of startups is they just don't have a market for the product, so-called poor product market fit in the jargon. It's incredible, but there's still too many companies that spend too much time working on the product before they go and test it on the customer, whereas we want to see a product that's being tested on the customer right away, or speak to the customer and them telling us that there's a demand for this product before we invest. So that, we hope, mitigates the risk to some extent, but yes, there will be failures. We're a young VCT, as you say. We've only been investing for 18 months. I think it's too early to tell, but I guess the other key thing to say is when we do invest, we're always looking for businesses that could potentially give us a 5 or better still 10 times return on the individual investment. Now, they're not all going to do that, and of course some of them are going to fail, most of them aren't going to do that, but if we focus on that big return, and we do get that from some of them, then that of course is the idea of venture capital compensating for your failures.
Finally, if people want to invest in a VCT this year, why should they invest with you? We
think there's a new normal, a new technology normal, and if anything, COVID has accelerated that. So, I wonder if you do want to still add to VCTs where you're adding to legacy portfolios, perhaps with bigger companies with older business models, maybe more debt, that sort of thing. Maybe you should have a look at our VCT, and 3 things I think that you can think about there are, we're investing earlier stage. The reason we're doing that is we think that we can get better valuations. Secondly, that we use our challenge-led approach rather than being product-led, which we think will help to mitigate some of the risks. And we have that laser-like focus on B2B technology. So there's no direct consumer risk in there, which has been a bit of a blessing in the COVID era as it happens. And thirdly, the VCT itself is quite young. So as I mentioned earlier, we came into COVID 55% cash. We've continued investing. We've seen some good opportunities this year. But we're still 40% cash as we speak. We will continue to invest in the next 6-9 months, deploy that capital. As I'm sure some others may have said to you, often crises are a good time to invest in new ventures. Looking back at the financial crisis 12 years ago, you had B2B companies like Groupon, Slack started then. Also the more consumer-like companies like WhatsApp. Lots of innovation. There's lots of innovation going on right now, and we have the cash to invest in that. And one final thing, Alex, just because I know that you are also an investor in VCTs, and you probably have a nicely diversified portfolio. Diversification is, one key word in investment, and we just encourage you this year. You've got all of this shock of COVID. There's a lot going on in technology. There's a lot going on in the B2B technology that we focus on. Maybe it's a good year to look at a smaller, younger VCT investing in earlier stage companies in that segment where we can try and give you some great capital growth longer term.
Ian McLennan, of Triple Point Ventures, thank you very much.